All right, let's go. So hello everybody, my name is Terry Bryan and I'm a Member Services Consultant with Tasplan. With me today, as usual, is another of our Member Services Consultants, Danielle Bartlett, as well as our very special guest for today, Michael Jordan. But I'll get to Michael in a moment. Now, Danielle will be in the background monitoring all of the questions for you today. So Danielle, can you please say hello?
Hello everybody, and thank you for joining our Centrelink webinar today. And at the end, we'd really appreciate your feedback. We do put up a poll just asking 5 basic questions just to gauge how you thought the webinar went and if you have any feedback. So we really appreciate your feedback at the end, and feel free to type your questions as we go.
Thanks very much for that, Danielle. And speaking of questions, if you do have any questions, please feel free to type them into the Q&A box that you'll see at the bottom of your screens. Now, please remember, however, that we have limited time today, so we may not get to everyone's questions in our allotted time. However, we have made time specifically at the end of the presentation for any questions that you have for Michael. And for those who are wondering, the presentation should take roughly 45 minutes. Now, before we start, however, I'd just like to remind you all that this presentation is of a general nature only and does not take into account your own personal situation. Should you have ever require personal advice, we always recommend that you speak with a financial planner. And speaking of financial planners, with us today is one of our own financial planners, Michael Jordan. Michael, thanks for joining us today.
Thanks, Terry.
Now, Michael is a fully qualified financial planner with extensive experience in the super sector. Michael has a Bachelor of Commerce degree from the University of Tasmania and is a graduate diploma of financial services from Tasplan Professional. He's also a member of the Financial Planning Association of Australia. So without any further ado, I'd like to hand it over to Michael. And Michael, thanks very much again. Let's take it away.
Thanks, Terry. All right, thank you everyone for tuning in tonight. Appreciate that it's news hour. I'd normally be home watching the news as well, so appreciate you tuning in to potentially learn some more about some Centrelink. Look, I'm quite thankful that we're doing this from the office because it's probably the only way I can guarantee that there's not a couple of kids that are going to interrupt us in the background. So lots to cover today. The main thing we'll be covering though is the age pension with Centrelink. But on the agenda, we'll talk about when you might be eligible for that pension, how to apply for the pension, when you can apply for the pension, how much you might be able to receive in the pension, and how that is calculated based on what we call means testing, which is your level of assets and your income. We'll talk about who might be able to help you with all of that process, as well as we'll finish off with a case study and some questions. So plenty to get stuck into in half an hour or so. So let's get into it. So when am I eligible for a pension? So for a long time, the pension age for most people was age 65. However, since about 2017, it's been gradually increasing to age 67. There was a proposal in the 2014 budget to increase that to the age of 70, but thankfully Scott Morrison scrapped that idea last year, and it's still at 67. So basically you'll see there's a bit of a sliding scale still for the next few years, but come 1 January 2024, where everyone will need to be age 67 to qualify for the age pension. Now, there are payments that you may be eligible from Centrelink in the lead up to the age pension, but as I said, today we're more specifically talking about the age pension. Okie doke. When can you apply? Well, Centrelink will allow you to apply for the age pension up to 13 weeks before you become age pension age. So that allows you to get ready, get your application into Centrelink, and know that if it's all there ready to go, it'll be paid from the day that you're eligible for that. One small thing to remember with this one though is that being eligible age is only part of the equation. The other part is being eligible under the means test. And what I mean by that is I see a few people that may work right up to being age pension age or even beyond. If they go in up to 13 weeks before they age pension age, they may find that Centrelink would say, look, sorry, your income is still a bit too high. Until that income drops off or comes down below the thresholds, you're not eligible for the pension yet. So remembering that you can apply up to 13 weeks before being eligible by age, but you also need to meet the means testing as well. The easiest way to apply for the pension is to do it through MyGov, and in order to be able to do that, you need to link Centrelink as a service through MyGov. You may already have a MyGov account set up with the Medicare or the tax office and things like that set up. So obviously Centrelink is just another government department, so another part under that umbrella. In order to register Centrelink, you may need to get in contact with Centrelink first to get something called a customer reference number, or a CRN, which is everybody's individual number when it comes to dealing with Centrelink. And while you're there, you may as well ask for a linking code, which will probably make it a bit easier to link Centrelink as a service under MyGov. Now, of course, doing things online is not for everybody, so there is still a paper-based claim that you can do. However, I do find that doing it online is a lot easier because part of the application is pre-populated and pre-filled for you, and it avoids having to fill out lots of pieces of paper. Okie doke. So what are some of the payment rates? Now, there are different rates based on couples and singles. So you'll see here, what we're looking at the moment are the maximum rates of payment. So for a single person with the basic rate plus supplements is a maximum of $944 per fortnight. Now, in my job, obviously, I like to work in annual figures. So $944 per fortnight equates to about $24,500 per year. The rate for a couple per person is $711 per fortnight, which equates to about $18,500 per year. Now, of course, that's each. So a couple combined at the full rate of pension is about $37,000 per year. Now, of course, if only one person of the couple is eligible by age, it's only that $711 per fortnight until you both become of age pension age, and then potentially could receive up to $711 per fortnight. Now, a couple of things I'd mention here are that the Association of Super Funds of Australia, or ASFA for short, they regularly put out some numbers to say, what does your average single person and average couple need to live a modest lifestyle in retirement? And they would say the average single person needs about $28,000 a year. And just remembering that age pension was about $24,500 a year, so a little bit under. Same thing for a couple. They would suggest that you need about $40,000 a year to live a modest lifestyle, and the age pension only provides about $37,000 a year. So that's why it's always nice to have a little bit of a buffer, whether it be some savings, some super, to be able to top up those age pensions in order to boost your standard of living in retirement. Now, to calculate how much pension you would receive, Centrelink do means testing, which is what are your assets and what are your income. So there's essentially two tests. Now, it doesn't matter which you have the most of, whichever you have the most of, assets or income, and therefore provides you with the least payment, that's what you would receive from Centrelink. So in a way, as I say, it doesn't matter if you have lots of assets and no income, and that might be a scenario where you have some land or a shack or something like that is an asset but doesn't give you income. Centrelink say, look, I'm sorry, it doesn't matter that you don't have much income. You've got these assets that are means to support your retirement. That's the rate of payment you would have. Vice versa, I guess, if you had lots of income and minimal assets, which might be a scenario if you were still working, so you had some employment income but minimal assets, or if you had a life pension, which RBF might provide. So you might be up here with income and down here with assets. Again, because it's your income is the higher, that's what would dictate your rate of payment. So I think the majority of people I see would be asset tested by Centrelink. So let's get stuck into what are some of the assets. So this list that you will see here, it's not exhaustive. It's not every single asset that Centrelink would count, but it is the major ones. And importantly, as we run through these, Centrelink are interested in the market value of assets. So what would you receive if you sold the asset, which is a bit easier when it's something like money in the bank, it's what you would get for it, whereas things like motor vehicles and so on are a bit different. Centrelink would discount any loans that you have on these assets on the value, and I guess that's most particular in things like real estate. You may have an investment property with a mortgage. It would be the net value that Centrelink look at that. So now, I guess the major ones here for me would be real estate, so shacks, blocks of land, investment properties, income streams from superannuation. So once you've built up your super and you're starting to now draw down on it, that would be counted as an asset, as well as superannuation itself, and any other financial assets, which are things like shares and savings accounts, term deposits, and so on. Now, Centrelink, if you are a couple, Centrelink do assess your level of assets as a couple combined. I've often seen it where person A might be eligible for the pension by age, but person B is not yet eligible, and they might think, well, you know, that investment property is in person B's name. Does that account for me? Yes, it does. Every asset is assessed as a couple, whether you're age, pension age or not, with a couple of exceptions, which I'll touch on in a minute. Okie doke. Now, some of those other assets that I mentioned before, motor vehicles, boats, caravans, household contents and personal items. Now, a couple of quick notes there. Household contents, Centrelink are interested in the fire sale value of household contents. So they're quite happy to accept up to $10,000 for household contents. And these are things like your white goods, your lounge suites, TVs and so on and so forth. So up to $10,000 without really asking any questions, unless you think they're significantly more than that. But just remembering things like antiques or artwork and things, they would be listed under personal items here, so they don't fall under household contents. I find some people sort of struggle to understand the value of things like motor vehicles and real estate. So what I find is easiest to do there is to go to something like carsales.com.au, punch in your vehicle type, the model, the year, how many kilometers it's done, and you'll soon find what someone else is selling for the value of your car, and that's an easy way to get the value. And similarly with things like realestate.com.au or domain.com.au, they do generally have some price ranges for what they think your property may be worth. So that sort of helps you to confirm that. Now, if you put something down for the market value, for example, with a shack or something like that, and Centrelink don't think that might be the case, they'll soon have it valued for you anyway. Okay, so that covers what's included as assets, but there are a couple of big ones that are not included as assets. And as most people would know, the family home is not considered an asset by Centrelink, whether that's worth $300,000 or $3 million, it's not counted as an asset, subject to it being your principal place of residence, so the family home, and a limit of the family home and up to the first 2 hectares, which is about 5 acres. So the house in the first 5 acres is not counted as an asset. If you're in a situation where you're on a land larger than that, they may assess some of the land outside of that, but I check that on an individual basis because there is some tricky rules when it comes to farming land and things like that. Funeral bonds or prepaid funerals are also not assessed as an asset by Centrelink up to a certain level. And one other big one is, although I said previously all assets are assessed as a couple, whether one is age, pension age and one is not, such as real estate or bank accounts or share portfolios. The one big one that's not counted is superannuation. So if you have one person who is eligible for a pension by age and one who is not, the person's superannuation of the person who is not eligible is not assessed as an asset until they reach age, pension age themselves. Now that is as long as it's in what we call a normal accumulation superannuation account, where it's still in the building phase, if you like. If it's turned into an income stream and it's on the downward phase, Centrelink will count that as an asset, whether you are age, pension age or not. So just bearing that in mind, super of someone who's not age, pension age is not counted as an asset. Okey-doke. What are you allowed to have? In order to be eligible for the full pension, a single homeowner is allowed to have up to $268,000 worth of assets and still receive the full pension. So if you have 168 or 250,000 worth of assets, you would receive the full pension. And we talked about those full rates a minute ago. Now, as a homeowner, that obviously discounts and doesn't include the family home. A couple combined is allowed to have up to $401,000 as assets before the full pension starts to reduce. Non-homeowners are allowed to have slightly higher levels of assets, essentially to reflect that you don't have home ownership. Now, importantly, I guess a non-homeowner is not someone who has a house with a mortgage against it. It is a non-homeowner, such as someone who is renting. Now, these full rates of pension under the asset test reduce by, for every $1,000 of assets you have above those levels listed there, your pension would reduce by $3 per fortnight. And we'll look at where it now cuts off, which is if you are a homeowner single person, you receive full pension, as we say, at $268,000 and no pension once your assets reach $583,000. So it's a sliding scale from full pension at $24,500 per year at $268,000 all the way up to $583,000 where the pension is cut off at that point in time. So, and if you're halfway up the ladder, if you like, you've received half the pension and so on and so forth. Similarly with couples, full pension, if your assets are below the $401,000 and a sliding scale of full pension to no pension once your assets are assessed as above $876,000. So not a huge window if you think of full pension to no pension in terms of the asset test, when that compares to something like the income test, which we'll get into. So what counts as income? Now, there's lots listed there, but I think the majority fall into these three here, which are gross employment income, so income from working. Now, importantly, when it comes to work income, Centrelink have something called a work bonus, which is essentially what they're saying is there that they'll disregard the first $300 per fortnight of employment income that you earn before reducing your age pension from that point on. Now, the great part about that as well is that it's like a bank. So if you don't work one fortnight and you build up the $300 to carry over to the next fortnight, so you can essentially earn up to $600 that next fortnight before the pension is reduced. So it does carry over fortnight to fortnight. Second big one, I guess, in retirement might be real estate income. You may have a rental property and you receive rental income from that. Similarly to tax, Centrelink will assess the gross amount of rent minus deductions that you have, such as rates, insurances, land tax, all those sorts of things. It's not exactly the same as net rent for tax because they won't allow depreciation on that. But all those other major deductions, they will assess the net rent. And thirdly, there is financial investments and includes super, but financial investments are things like shares and bank accounts and superannuation and some income streams. And with that, what they do, what's called deeming, which basically with financial assets, as I say, that's mainly shares, savings accounts, some superannuation accounts and so on. Centrelink don't assess what it actually earns. Now, because that can be really difficult to say, what are my shares earning on a fortnightly basis? What's my super doing on a fortnightly basis? So what they say is we'll disregard what it actually earns. We'll disregard what you actually take out of that account. What we're going to account is essentially what should it earn if it was in a glorified savings account, so a notional amount of earnings. So for a single person, they'll say your financial assets, again, I need to make clear, super, savings, shares, and so on. They're saying that the first $53,000 earns 0.25%. That's how much income they'll attribute to your financial assets. Above $53,000, they'll assess it as 2.25%. And this is where it gets a bit contentious because it's easily argued that it's hard to find 2.25% in a term deposit and so on. A couple is allowed to have up to $88,000 at 0.25%, and then anything in excess of $88,000 is the same 2.25%. So 0.25, above 88, 2.25, and that's your level of deemed income. Okay, so again, under the income test, what are you allowed to have? So to receive full pension, a single person is allowed to have up to $178 each fortnight before the pension starts to reduce. And as you'll see down here, for both singles and couples, the pension reduces by 50 cents for each dollar that you have above $178 per fortnight until it reaches that cutoff point, similarly to the asset test. A couple combined is allowed to have up to $316 per fortnight before the pension starts to reduce from there on. Now, similarly to the assets, that's the base. You can have up to that level of income and receive the full pension, and then it starts to reduce as you have your assets above that to these pension cutoff points. And as we'll see there, for a single person, you wouldn't receive any pension once your income in a fortnightly period. Now, it is fortnight to fortnight. It is not an annual amount of income. It is fortnight to fortnight, and that can be really reasonably important. So a single person cuts off at $2,000 a fortnight, and a couple cuts out at about $3,163 per fortnight. Now, just trying to annualize those again, that means for a single person, full pension up to $4,600 per year, and then sliding scale of receiving less from Centrelink once you get to 53,000, which is a cutoff point, $53,000 per annum, done on a fortnightly basis. Similarly, for a couple, 0 up to $8,200 per fortnight would give you full pension, from $8,200 all the way up to $82,000 before it cuts out for a couple. Now, as I was saying before, that's actually quite a bigger window of assessment than the asset test, 8,000 to 82,000. So, okay, what else do we need to consider? Now, I've covered the deeming there, so I won't dwell on that again. Other benefit payments, look, in the lead up to being eligible for the age pension, you may be eligible for other payments from Centrelink, which we're not really covering in today's session. These are things like the old New Start allowance, or now Job Seeker allowance, and there's certain rules on those as well. Waiting periods, again, there's a bit of a misconception with waiting periods. They don't really apply to the pensions. So the age pension, it doesn't apply to. That generally applies to things like the New Start allowance and so on. The big one I'll mention here is gifting. Now, gifting is essentially where you give away an asset and receive less than what it's worth, less than market value for that. Now, that's easy if it's cash. If you give away 50,000, receive nothing for it, that's the amount you gave away. But it could also be that you sold something to a relative or someone at less than market value. So if you know your investment property's worth $300,000, but you decide to sell it to your son and their wife for $250,000, technically that is a gift of $50,000 as well. So Centrelink will assess that. If it's a bit different though, if you've had it valued, you think it's worth 300 and then you sell it on the open market at 250,000, well, that's just the market telling you what it's worth. So it's not a gift, it's just that you overestimated, or Centrelink helped you overestimate it in the first place. Now, I find that that people tend to think gifting with Centrelink is a penalty. It's not really. You don't receive any more or less income from Centrelink as a result of gifting. So it's not a penalty. You don't lose any more. It's just that you don't receive any more. And that's on the premise that you can't sort of get to a month before you qualify for the age pension, give all your assets away, and then say, look, I don't have anything, I'm eligible for a full pension. So Centrelink say, we'll let you give away up to $10,000 per financial year, with a maximum of $30,000 over a 5-year period. So you can give away $10,000 per financial year, but then nothing for those next 2 years after that. Now, again, reiterating, you can give it away. It's just that that's how much Centrelink allow you to give away before they will start to count it. So if you give away $50,000, Centrelink will disregard the first 10 and say, that's okay, you can give that away, but that other 40, we're going to now count that for a period of 5 years from the date you gave it away. Now, importantly, that's not that doesn't kick in after your age pension age. That is in the lead up to age pension age. So if you're 3 years away from the pension and you give away 50,000, they'll count that 40,000 excess for the first 2 years that you're eligible for the pension. So, and then once you've sort of that 5-year period is up, it does drop off as an assessable asset. And the way that they assess that is as a financial asset. So it's just like you've still got some savings there as an asset and therefore deemed as well. Now, importantly here, transferring assets between a couple, you know, if husband gives $20,000 to wife, that doesn't matter because, again, Centrelink are saying we're counting all your assets as a couple combined anyway. So transferring assets between the couple doesn't make a difference. It's just if you give it away and therefore have less Centrelink accessible assets. Okay, now who can help you with all of this? Now, Centrelink have what they call Financial Information Service Officers, or FIS officers. They can help you understand, are you eligible for benefits? Again, age is a bit easier to understand. You either are eligible age or not, but things like New Start or Job Seeker allowance. So they can help you understand, are you eligible? They can tell you how much you might be stand to receive in a year from now when you turn age, pension age. So they can help you, educate you with all of those things. But I guess importantly, they can't advise you. They can't tell you how to improve it or what to do to maximise it, which is, I guess, essentially where financial planning comes in, because we look at the broader spectrum of your financial situation, your assets and things, and help you maximize it if you can, or at least understand your position to see how much you're going to receive and so on. Now, advice at Tasplan comes, I guess, in 4 different ways. At each different level, different things apply. So at level 1 there, general advice is factual information that can be provided over the phone or in a meeting. And it's they're the questions of, can I do this? Well, that's a fact. Yes, you can, or no, you can't. I guess anything beyond that is what we call advice. At intra-fund advice there, that's where it's based on your Tasplan account. You know, am I in the right investment option for me? Am I contributing the right amount for what I want to achieve in retirement? And based on where I'm at now, how much am I going to have in retirement on forecasting and things like that? Scaled advice does start to bring in some things outside of superannuation, understanding your tax and those sorts of things. But at the bottom end there, comprehensive advice is, I guess, where my role is, that we provide the broad spectrum of advice on superannuation, Centrelink, estate planning, all those sorts of different areas of your financial situation. Now, the last thing I wanted to cover here is just, I guess, an example where we did help a couple. We've got Bob and Marlene here, and this just I guess explains how financial planning did assist this couple. Now, what Bob and Marlene's situation is that Bob's age 66. He's just reaching age pension age. He's got a fair bit in super, $700,000, and outside of their super, they own their own home, which is not counted as an asset, and they've got $50,000 worth of other assets there, which are, you know, their home contents, a couple of cars, those sorts of things. Now, Marlene's only 60. And she has minimal super at the moment, which isn't counted anyway by Centrelink. And this is where we've got an advantage to start to transfer some wealth across from Bob's name into Marlene's name to maximise Centrelink. So under this current format where the money's held in Bob's name in superannuation, they've got $750,000 worth of assets, which would give Bob an age pension of about $4,900 per year, or $189 per fortnight. In June this year, we decided to help Bob and Marlene start to transfer some money out of Bob's superannuation over into her name. So we transferred 100 grand, which is within the allowable limits. And then a month later, in July this year, in the new financial year, we transferred 300 grand across from Bob over to Marlene. Now, all of a sudden, as a result of transferring $400,000 out of Bob's assessable account, which is, you know, in his super or in his income stream, it is assessable. In Marlene's, it's not. We're able to increase him to the full pension. Again, an increase from $4,915 per year to 18.5, which is, you know, an extra 13 grand. So An extra 13 grand, it is short-lived in some respects because it is only not assessable in Marlene's super until she reaches pension age. Now, but because she's only age 60, she's not eligible for the pension until 67. So it is 7 years of this increased benefit. 7 times 13 is nearly 100 grand's worth. So a decent increase, done over the course of a month, and it really helped to boost Bob's age pension entitlements. Now, it's not, a straightforward. It sounds straightforward, but simple strategy. But you need to make sure these contributions are within the limits. You also need to make sure that Marlene has access to a super. Now, this worked in this scenario here because Marlene's age 60. So when we transfer it out of Bob's and into Marlene's, she has tax-free access to a super. She's retired. Whereas if Marlene was a bit younger and still working perhaps and didn't have access to the super, it's not as straightforward. That being said, Bob was initially a bit disappointed that we took some money out of his and put it into Marlene's, but when he realised we're getting a higher pension, there's reason behind it. But he still does have 300 grand left in his superannuation to draw down on until Marlene reaches pension age there at 67 anyway. So there still is a decent chunk left in Bob's superannuation.